Welcome to The Explainer. Today, we're diving into a huge contradiction that's happening in the market right now. See, on one hand, people are more pessimistic about the economy than they were during the 2008 financial crisis. But on the other hand, stocks are right near their all-time highs. We're going to break down this puzzle and reveal a massive underlying force that could be the single most important driver for your investments over the next decade. So, let's just kick things off with a kind of provocative idea. What if all this fear, all the bad news we keep hearing, is actually the best possible sign for investors? I know, it sounds completely backward, but understanding this is absolutely key to seeing where the market is really headed. And this slide, wow, it just lays out the puzzle perfectly. Look at this. On the left, consumer confidence is at rock bottom. We're talking lower than during the 2008 meltdown and the COVID crash. Yet on the right, the stock market is just a stone's throw from its all-time high. So how is that even possible? How can things feel so bad when the market is so strong? All right, to figure this out, let's dig into our first puzzle, what we're calling the pessimism signal. We're going to explore the idea that all this widespread fear might not be a warning sign to run away, but actually an invitation to get in. You know, the key to understanding this lies in something called the contrarian opinion theory. It's a pretty simple but really powerful idea. When almost everyone in the market agrees on something, they're usually wrong. So when you see extreme pessimism, it can be a huge buy signal, basically because it means all the sellers have already sold. There's almost nobody left to push the price down. This number, 32, it tells a really powerful story. It's the current reading from the CNN Fear and Greed Index, and on that scale, anything below 50 means fear. So get this, even as stocks are touching record highs, the main emotion out there among investors isn't greed or excitement, it's straight up fear. That's a classic contrarian signal right there. And it's not just investors. This data from the University of Michigan's consumer survey is, honestly, it's shocking. It shows that the average person on the street feels worse about the economy today than they did in the absolute depths of the 2008 financial crisis. Just let that sink in for a second. The vibe is literally at a historic low. But here's the massive disconnect. The feeling out there is terrible, but the actual reality of the economy, it looks incredibly strong. I mean, the S&P 500 is knocking on the door of its all-time high. The economy is actually growing. The markets are expecting the Fed to cut rates. Companies are beating their earnings forecasts. Oh, and there's talk of even more government stimulus. The hard data is telling a completely different story than the public mood. So here's the big takeaway from our first puzzle. When you have this much pessimism mixed with really strong economic fundamentals, it creates a powerful setup. This suggests that hard assets, things that have a limited supply, like stocks in the S&P 500 or gold or even Bitcoin, are probably going to do pretty well as they climb that classic wall of worry. Okay, now for our second puzzle. And I know this one's going to seem totally unrelated to market sentiment at first, but trust me, it's the missing piece that connects everything. Let's talk about the AI energy crisis. This quote just nails it. It perfectly captures the single biggest roadblock for the entire AI revolution. All these companies are building these massive, powerful data centers, but they're running into a very, very basic problem. There just isn't enough electricity to power them. So just how big is this problem? Well, the US Department of Energy estimates that just to power the coming wave of AI, the country needs up to 70 new large-scale nuclear power plants. That is a staggering amount of new infrastructure. And this right here is where the challenge really turns into a crisis. Just look at this chart. In the last 30 years, the US has built only 2 new nuclear plants. Meanwhile, China has 29 under construction right now. The US it's not even close to being on pace to build the energy infrastructure it needs for this AI revolution. And look, this isn't a problem you can solve quickly. It's not like you can just flip a switch. The timeline for a new nuclear plant, from the moment you start planning to the day it actually generates power, is more than 7 years. We're already way behind schedule. Okay, so we've got these two big, seemingly separate puzzles. We've got widespread pessimism in today's market, and we've got a massive energy crisis brewing for tomorrow. Now, let's connect the dots and see how they both lead to the exact same inevitable solution. The cost of building out this new energy grid is, well, it's astronomical. It's way too big for private companies to handle on their own. The estimates are just staggering. For every $1 of private investment, the US government will probably need to spend $4. This isn't just a project, it's a national level mobilization that's going to require massive public funding. So you can see how this sets off an unavoidable domino effect, right? AI demands way more energy. Private companies can't possibly afford to build all the infrastructure, so the government has no choice but to step in and fund it. And how does the government fund something this huge? By creating new money. In other words, a sustained, massive injection of liquidity into the financial system. And this is it. This is where our two puzzles crash into each other and point to a single answer. The solution to the long-term AI energy crisis is the exact same thing that's supporting the market in the short term, a massive, ongoing flood of liquidity from the government. They have to print money to build the future, and they have to print money to support the present. So this all leaves every single one of us investors with one critical question to think about. If we are really heading for a future of massive and sustained liquidity injections, where do you put your money? In a world where cash is being constantly created from thin air, where will real value find a safe place to hide? That's the question we'll leave you with today.